So now, what do we mean by group, or what do we mean by consolidation or business combination? Now, this happens where there is a company, let's call it X Limited. One company acquires another company. Let's assume that X Limited acquired Y Limited more than half of its stake. That more than 50%, that's between 51 to 100%. Now, this means greater than. If you acquire 50%, that one does not qualify to what I want to mention. Now, the company acquiring the other company is known as the holding company or the parent company. And the company being acquired is known as the subsidiary. So this is the parent company. If you acquire another company more than half, when I talk about more than half, I'm talking about 50 plus 1. That one becomes a subsidiary. Now, let's assume X acquires Y 90%. So that means Y will be a subsidiary to X Limited. Now, in Y Limited, if we have acquired 90%, there is some proportion of the holding which has not been owned by X. That is 10%. How do you call this 10%? Now, this 10% is what we call the NCI, or the non-controlling interest. Non-controlling interest, that's the NCI, also known as minority interest. Then X Limited, the parent company, can also acquire another company, let's call it Z Limited, between 20% of its share to 50%. Let's assume that X acquired 30% shares of Z. So that means since it's not more than 50%, it's between 20 to 50%, now Z is known as an associate, also known as the joint venture. Can either be an associate or joint venture. So therefore, what's the difference between a subsidiary and an associate? Now, for subsidiary, since we have more than half of the ownership, that means we can control them. So that means for subsidiary, you can control. In associate, you don't have more than half of the holding. So therefore, X cannot control Z, but they can have what you call a significance influence. You can influence them, but you cannot dictate. So here you'll have a significance influence. So that's the difference between a subsidiary and an associate. For subsidiary, you can be able to control. You know what I mean by control? Control, that means you can dictate. For example, I'm controlling this class. And nikisema toka hapo uende pale unaenda haraka. Sawa sawa. What about significance influence? Now, significance influence, also you as a student, you have a significance influence in me. You can tell me, teacher, kindly repeat that. So it's upon me now. I can either accept or reject. Nisiporudia, hakuna kitu utafanya. Now, that's what we call a significance what? Influence. You can just influence, but you cannot control. So that's the difference between a subsidiary and an associate and the parent. That means it's an obligation now of the parent company. If the parent company has other subsidiary, at the end of the year, you need to consolidate the financial statement of all you are investing. And that's why, for example, if you take a company like Equity, also Safaricom, the company that has other companies, has acquired other companies. When they are presenting their financial statement for the group, you'll see Equity group of companies. So that's what we call consolidating the financial statement. Now, note that when consolidating, we only consolidate the holding company and the subsidiary. We don't consolidate associate. Now, for associate, we'll come to discuss later on how to account for associate. We account for associate using the equity method, and that one is provided under IAS 28. So note that when consolidating, we only consolidate the parent and the subsidiary. We don't consolidate the associate or the joint venture. Good. Then we look at what we call the group structure. And for group structure, we have three types of group structure. One is the horizontal structure. And the horizontal structure happens where the holding company has more than one subsidiary company. Might have A, B, C, and D. A owned B 90%, A owned C 60%, A owned D 55%. So this is where the parent company has more than one subsidiary, or alternatively, all the subsidiaries are under one umbrella parent company. Then number two, we have what you call the vertical structure. Now for vertical structure, this happens where we have company A, which is the parent company. Now the parent company acquires another company, let's call it B Limited, a subsidiary. Let's assume that A acquired B 90%. So that means B becomes a subsidiary to A. So this is a subsidiary. And since we are controlling 90%, there is an uncontrolling interest of 10%. Then the subsidiary acquires another subsidiary. So B Limited acquires, let's call it C. B acquires another subsidiary. Let's assume that B acquired C 80%. Now, who is C? Now, C is a subsidiary to B, but B is a subsidiary to A. Now, this is what we call now a sub-subsidiary. Now, in this case, the parent company is the one that will consolidate the financial statement. Now, the question is, how does A control C? Remember, A owned B 90%. Then B acquired another company. So that means of what B spent to acquire C, 90% was contributed by the parent. So therefore, if B can control C, also A can control C, but indirectly through B. So the question is, how does A control C? Now, A controls C indirectly through B, and that is 90% of 80%. So 90% of 80%, you get 72%. So that means the non-controlling interest in C by A will be 28%. And then lastly, we have what we call the mixed structure, also known as D structure. So what's a mixed structure? Now for the mixed structure, this happens where A Limited acquired B 80%. So that means A is the parent, B is the subsidiary. Then A also acquired C. Let's assume 30%. So if A acquired C 30%, that means that C is an associate to A, but B is a subsidiary to A. Then the subsidiary decided to acquire shares in the parent associate. Now let's assume he also acquired 30%. So now, who is C? Now C can be an associate, also can be a subsidiary. How do you determine that? So how does A control C? Now A controls C directly 30%. So the direct ownership, directly it's 30%. Also, B acquired C 30%, of which B is being controlled by A. So that means A can also control C indirectly through B. And that indirect control, it will be 80% of 30%. So 80% of 30%, which is 24%. So how much is the total control? 54%. Therefore, who is C? Yeah, C is a subsidiary. Good. As it was that. I hope now you understand the difference between a parent company, the subsidiary, and the associate. Good. Now, since you're acquiring one company, if you're acquiring them, that means you are paying them. Yeah, this one we did in partnership. When one company acquires another one, what do we call the difference between the purchase consideration and the net asset acquired? The difference between the purchase consideration and the net asset acquired. Goodwill, correct. There is what we call the goodwill. And what's the goodwill? Now, goodwill is the difference between the purchase consideration and the net asset acquired. That's what we call the goodwill. And under IAS 10, we have two methods of determining the goodwill. One, there is what we call the full goodwill method. And then number two, we have partial goodwill method. What's the difference? Now, for full goodwill method, this is why you compute the goodwill of the subsidiary as a whole. That is, you take the parent proportion, including the non-controlling interest. That's what we call the full goodwill. This is where you compute the goodwill of the subsidiary as a whole. That is the parent proportion and the non-controlling interest. Then for partial goodwill method, this is where you only compute the goodwill of the parent. That's the parent proportion goodwill in the subsidiary. And this is what I mean. A, acquired B Limited, 90%. So that means A Limited is the parent company, B is the subsidiary. At the date of acquisition, the net asset of B, assume, was 500 million. That was the net asset of B, or in short, B was worth 500. But A, to acquire this B, paid an amount of 520 million. So how do we get the goodwill? You take the purchase consideration, which is 520, you minus the net asset acquired, and the net asset of B was an amount of 500. So that means there was a goodwill of 20. Now that's what we call the full goodwill. What about the partial goodwill method? See that for the partial goodwill method, you only take the parent proportion. The parent paid 520 to acquire B, of which the net asset of B was 500. But of this 500, we only acquired 90%. So you take 90% of 500. Now that's what we call the partial goodwill. So in this case, we have already considered the parent proportion, therefore ignoring the other 10%. But in this case, for full, you took 100%. That means 90% of the parent and the non-controlling interest of 10%. Good. So therefore, how do we compute the goodwill? Now, to compute goodwill, you see that you'll be taking the purchase consideration minus the net asset. How do we get the net asset? Is the total assets minus what? Hey, how do you get the net asset? It's asset minus liability. Or how do we get capital? Capital is also asset minus liability. So that means the capital employed is also equivalent to the net asset. So therefore, this is the general formula on how to compute the goodwill. Now, goodwill, you'll take the purchase consideration then you raise the amount of net assets acquired. And how do we get the net asset acquired? You see that for the net asset, you take the assets minus liability. But most of the assets, that's the current assets and current liability, they are prone to change. They change every time. So instead of using now the assets minus liability, we use the capital employed or the capital, which is the same as equity, because most of the equity elements are always stable. And that is ordinary share capital also we have the share premium. And then for other reserve like retained earnings. Retained earnings keep on changing each year because retained earnings will be affected by the profit for the year. But in case of an ordinary share, that one does not change, not unless the company issues new shares. So therefore, for reserves, you'll be taking the pre-acquisition. If it's retained earnings, you take the pre-acquisition retained earnings, as well as the pre-acquisition reserves, such as revaluation reserves. So once you get the net asset, then you multiply by the proportion. So now the difference between the purchase consideration and the net asset acquired, that's how you get the goodwill. Alternatively, or when now this is what we call the partial goodwill method. If you use the full goodwill method, you'll take the purchase consideration, then you factor in NCI fair value. if you have to use the full goodwill method. So you take the purchase consideration, then you add the NCI value. Then when you get the net asset, don't take the proportion. You take 100%. So if you're using the full goodwill method, you take the purchase consideration plus NCI fair value. Then you raise the net asset in full. If you're using the partial goodwill method, you take the purchase consideration only. You don't factor in the NCI fair value. Then you raise the net asset. Now for the net asset here, now that's when you factor in the proportion. What is the case? Now let me take you back to IAS 10. Sorry, IFRS 3. Sorry, this is IFRS 3. Now IAS 10 is on business combination. Now under IFRS 3, it provides on how to account for goodwill as well as how to account for NCI. So how do we measure NCI? Now, under IFRS 3, we have two methods you can use to measure NCI. And how you measure NCI also determines which method to use to determine the goodwill. And number one, we measure NCI at fair value, NCI at fair value, or you measure NCI at proportionate share of subsidiary net assets. Those are the two methods of measuring NCI. You measure NCI at fair value or NCI at the proportionate share of the subsidiary net asset. Now, if you measure NCI at fair value, you use the full goodwill method to compute the goodwill. If you measure NCI at the proportionate, that means you are taking the percentage. You use the partial goodwill method. And that's what I'm trying to explain here. That if you're using the full goodwill method, you take the purchase consideration, you add NCI fair value. Then you deduct all the net asset. There is no proportion. If you use the second method, that's the NCI at the proportionate share, you'll only take the purchase consideration, you won't factor in the fair value. Then you take the total net asset, then you take the proportion, NCI at proportion. So here you take the proportion of the parent, and then you deduct that. That's how you get the partial goodwill method. So therefore, the method used to determine the goodwill depends on the method used to measure the NCI. Good. Now take out your notes. Now we discuss on what you have in your notes. I had shared with you the notes in advance. So business combination. Now, what do you mean by consolidation? Now, consolidation or business combination refers to bringing together of separate entities into one reporting entity. So we're using our notes. In case you don't have your notes, you can also use your handout for those taking financial reporting. Handout page 57, I've also provided the notes there. You have the handout, use handout page 57. If you have the notes, we're on page 1. The notes. So saying that consolidation or business combination refers to bringing together of separate entities into one reporting entity. The result of all business combination is that one entity, that's the acquirer, obtains control over one or more entities. Business combination brings about the parent-subsidiary relationship. And then what's a subsidiary? A subsidiary is an entity that is controlled by another entity for more than 50% of its equity share. Now, can you underline more than 50%? And I insist, more than 50%, not 50%. More than 50%. Good. So what do we mean by control? Now, control is the power to govern the financial and operating policy decision of the investee. Yeah, is the power to govern the financial and operating policy decision of the investee. Now let's go to the last bullet. The last bullet, that's non-controlling interest. So what's NCI? Now, non-controlling interest, this is the proportion of the net asset in the subsidiary that's not owned by the parent company. Yeah, Can you write in bracket? We see that NCI is also known as what? It's also known as minority interest. Can you write in bracket minority interest? So that whenever you see minority interest, I know that they are talking about the NCI. Good. Then IFRS 3 allows two alternative methods of determining NCI. So how can we determine the NCI? Number one, NCI at the proportionate share of the fair value of the subsidiary net asset. Write in bracket, partial goodwill method, partial goodwill method, partial goodwill method. Then number two, NCI at fair value. Write in bracket, full goodwill method, full goodwill method. And that's what I was trying to explain here. Okay? That under IFRS 3, the method of determining the NCI will determine the method used to determine the goodwill. Then there is group structure. I think I summarized everything about the group structure. Now there is a point note. There is an NB there on the first page. Only subsidiary is consolidated. And for ordinary share capital and share premium, only for the parent is recognized. Yeah, we say that when consolidating, we don't consolidate associate. For associate, we use IAS 27, not IFRS 10. Yeah, of which we account for associate or joint venture at using what we call the equity method. Therefore, we'll only be consolidating the parent and the subsidiary. We don't consolidate associate. For associate, we account for it using the equity method. Then you're also saying that for the ordinary share capital, we don't consolidate. Ordinary share capital and share premium, we only take for the parent. That means we don't consolidate ordinary share capital and share premium. That's what it means. That only subsidiary is consolidated, and for the ordinary share capital and share premium, only for the parent is recognized. Then there is preparation of consolidated financial statements. And before I read that, there is something I want to explain. We say that as a parent company, you are obligated to prepare consolidated financial statement for the group. But there are some circumstances in which the parent company is exempted from doing so. Now, what are those circumstances when the parent company is exempted from preparing the group account? So I want you to understand major 3 points. Number one, when the parent company is a private company. So if the private company is not a must to prepare the consolidated financial statement. But in case you are a limited company, that means your security are traded in the public market, you have to prepare the group account. That's one circumstance, when the parent company is a private company. Number two circumstance, when the parent is exempted from preparing the group account, is when the parent company is a subsidiary of another company. What does it mean? When the parent company is a subsidiary of another company. Now, for example, look at this case. Now, who is A? A is the parent to who? To B. But B acquired C. So who is parent to C? B. But you see this case, B is a parent to C. But B itself is a subsidiary to who? To A. So in this case, B being a parent to C will be exempted from preparing the group account, in that its parent is the one who should prepare the group account. So that's another scenario where the parent company is a wholly or partially owned subsidiary of another company. And then another circumstance, that's number 3, that's when the parent company is an investment entity. Yeah, such as Centum. Yeah, we have a company that are registered as Centum. Now, for example, if you ask you a simple question, what are some of the products of Bidicom? Bidicom, unajua nini? Mafuta, sabuni, good. Haya, tuende Centum. Give me some of the products of Centum. Siona hamjui. Yeah? Because for them, what happens? They are investment entity. They partner with other company to provide the capital. Anatengeneza to live a small, they invest in real estate. So what happened in that real estate? There was an investor there who had an idea, but there was no sufficient capital. Let's assume that in that required 1 billion, he only had 200 million. Then they approach Centum. That's when now the Centum come in. They finance the entire project, or they can add some. You see, in this case, if the investor had 200 of 1 billion, then Centum decides to add 800 million. So that means he's the major shareholder with over 80% ownership. So in that case, it will be exempted from preparing the group account. Why? Because if you look at the case of Centum, they have over 150 million companies or investment they have invested. And being constructing what we call a portfolio, the objective is one. You maximize on return, you minimize on risk. How do you minimize on risk? You minimize on risk by investing in different industries. In that, if one industry is affected, the other one won't be affected. That's what we call portfolio diversification. One of the requirements for consolidation, you should use the same accounting policy. That's one of the requirements for consolidation. But in this case, you see, of this in 150 companies, they are in different industry. So it will be difficult for them to consolidate all of them. So in that case, it will be exempted from preparing the group account. So those are the major 3 exemptions, where the parent company is exempted from preparing the group account. Number one, when the parent company is a private company, when the parent company is a subsidiary of another company, and when it's an investment entity. Good. So we are in the first page. Last item is saying that preparation of consolidated financial statement. Now the parent company prepares a consolidated financial statement using uniform accounting policy. Can you underline that? Uniform accounting policy. So you must use the same accounting policy. However, the parent need not to prepare consolidated financial statement due to the following. Now, those are the exemptions. So what are some of the exemptions for preparing the consolidated financial statement? Number one, when the parent itself is a wholly owned subsidiary or a partially owned subsidiary of another entity, of which the other entity prepares the group account. Number two, its debt or equity instrument is not traded in the local or foreign public markets. What does that mean? It means what? Yes, Adeka in bracket, private company. Yeah, that's what that means. If your debt or equity instrument is not traded in the public market, that means it's not a public company. It's not, therefore it's a private company. Then the other one, when it's an investment entity, e.g. Britam, Cyton, or Centum. Now you know about the last two. Just understand the first 3. Then there is goodwill on acquisition. I think I explained everything about goodwill. Now let's go to the other page, page 3. We look at investment in associate. Remember, I said that we don't consolidate associate. For an associate, we account for it using the equity method. So we look at investment in associate. Or joint venture. That one is provided under IAS 28. And we say that what's an investment or what's an associate? We say that an associate, this is where the investor has a significant influence. And how do you get a significant influence? When you own between 20% to 50% of the shares of that company. That's when you ought to have a significant influence. What if you have less than 20? Let's assume you have invested in another company for 10%. Now that 10%, now you account for it. You go back to IFRS 9. That's what you call a financial instrument. If you buy shares of another company, which is less than 20%, yeah, you consider it as an investment, what's called equity investment. So therefore, you apply IFRS 9 when accounting for it. So, but between 20 to 50 becomes an associate or joint venture. Then more than 50%, it becomes a subsidiary. Now you're saying that for associate, you don't consolidate. You only consolidate the parent company and the subsidiary. For associate, we account for it using the equity method. And how do you account using the equity method? For the equity method, you need to recognize the investment in associate as an non-current asset. And how do you recognize that? So investment in associate. Now, IAS 28 prescribes that when accounting for investment in associate, how do you recognize this investment? It requires that initially, you measure this investment at its cost. That means you take the cost of purchase, or that's what you call the purchase consideration, right? So you'll take the purchase consideration or cost of investment. That's at initial recognition. Then you adjust for the post-acquisition changes in net asset. You add post-acquisition changes in net asset. And then at the end of the year, being an investment, you need to assess for any impairment. So you assess for any impairment. In case there is impairment loss, you eliminate. So you deduct impairment loss. Now what you get here is now what you recognize with the non-current asset as an asset. That is investment in associate. So you're saying that, first of all, you initially recognize the investment at cost. So that means you take the purchase consideration. Then you add the post-acquisition changes in net asset. Now, mostly what changes is only one, the retained earnings. Now, this is what I mean. X Limited acquired Y Limited 30%. So that means Y is an associate to X. At the date of acquisition, that's what we call the pre-acquisition period. Assume the retained earnings was 100 million at the date of acquisition. Now, that's what we call the pre-acquisition retained earnings. And then at the reporting date, retained earning now is 120 million. This was at the date of acquisition. That's what we call the pre-acquisition retained earnings. At the reporting date is 120. So how do you factor that? You see that here you add the post-acquisition changes in net asset. So we are controlling this entity 30%. Then from the date of acquisition to the end, the profit changed by how much? That's what we call the post-acquisition changes. So from 100 to 20, there was a change by how much? 20. So you'll take 120 minus 100, you get 20. Now of that 20, you take your proportion, which is 30%. So you take 30% of 20. That's what it means. Good. So now let's go through that. Investment in associate, that's an IAS 28. Now, an associate is an entity over which the investor has a significant influence. So what do you mean by significant influence? Is the power to participate in the financial and operating policy decision of the investing. Yeah, you can participate. Where an entity holds between 20% to 50% of the voting power, and that's the equity, directly or indirectly, it will be presumed to have a significant influence. If the voting power is less than 20%, it would be presumed to have no significant influence, and hence it will be recognized as an investment. Right in bracket, AFS. AFS. We say that what is AFS? Available for sale. And we say that what available for sale. We say that under new IFRS 9, the financial assets are classified into three. Now, this one is an asset because you have bought shares of another company, so you expect some future economic benefit. So we say that financial assets are classified into three. Financial asset at fair value through P&L. We say that those are short-term investment. Number two, we say that there is financial asset at fair value through OCI, of which we say that it's also known as available for sale. We say that this one is a long-term investment. And this is it. And then number three, there was financial asset at amortized cost. Yeah, that's the new standard and IFRS 9 on how to classify those assets. Good. So the existence of significant influence by an entity is usually evidenced in one or more of the following ways. So in short, how can you exercise significant influence over the investee? One is representation on the board of directors of the investee. Then number two, participation in the policy-making process, including the dividend policy. Also, material transaction between the entity and the investee. interchange of management, personnel, provision of essential technical information, accounting for associate. IAS 28 revised requires associate company to be accounted for using the equity method. How do you apply the equity method? Now, equity method is a method of accounting whereby investment is initially recognized at cost. That's what I'm saying here. You take the cost of investment of the purchase consideration initially, and then adjusted thereafter for the post-acquisition changes in net asset. It is determined as follows. So now, there is something which I have not indicated there. You see, I say that it's determined as follows. Now, can you copy this? Copy this. So now let's proceed. Now we look at joint venture. Joint venture. What's a joint venture? Now, a joint venture recognizes its interest in a joint venture as an investment and shall account for this investment using the equity method in accordance with IAS 28. Also, for joint venture, you account for it, they use for associate. Now, what do you mean by joint venture? Now, reason up here. If company A acquired another company B, 50%, who is B to A? It's an associate or subsidiary? It's an associate. This is that for a subsidiary, it's like Kenyan election. For you to win, you must have 50 plus 1. Good. So it should be more than 50%. So that means B is an associate. But sometimes people say that it's a joint venture. Now it can be an associate, can be a joint venture. Now, how do you determine whether it's a joint venture? Assuming that B, we own 50%, then there is another company C, which owns 25%. Then there is another D, which owns B 25%. So B remains to be an associate. Now, when do we call it a joint venture? Now, a joint venture happens where now these three companies, they sit together and they come up with an agreement of having a joint control. So that means they're having the same effort to control this company. Now, that's when it becomes a joint venture. But in case there is no joint control or there is no joint arrangement, therefore it remains to be an associate. And that one is provided for under IFRS 11. It's the one who talks about the joint arrangement. So now let's look at joint arrangement. Joint arrangement. Now, this is an arrangement of which two or more parties have joint control. Two or more parties have joint control. Joint control is a contractual agreement of sharing control. And we have type of joint arrangement. Types of joint arrangement. So they are classified into two. Number one, there is what we call a joint operation. Then number two, we have joint venture. So what's the difference between the two? A joint operation, this is where all the venturers are responsible or they have a right to their asset, and also they have an obligation for liabilities. But for joint venture, this is where the venturer or the parties to the contract, they have only the right to net assets. What's the difference? There's one student who has asked me, he was trying to revise on published financial statement, and got a case where there was a joint venture. So now I hope you are here, you listen on how you account for joint operation. Now for joint operation, you're saying that the party, they have right to the assets, obligation to the liability. What does that mean? If this is a joint operation, A brings an asset to B. Let's assume a lorry. If you bring a lorry, any revenue will be generated by that lorry will go directly to you. Others will not get anything. And then obligation, that means who will pay that driver? You also the one to pay that driver. All together. So you have the right to the asset and obligation to the liability. But in joint venture, now this is where you treat B as a company. You buy 50%, end utulie, wachia company professionals. At the end of the year, just wait for the dividends. Now that's what we call a joint venture. So for the joint venture, you only have the right to the net asset. That's the equity. For the equity, then you wait for the dividend. But for the joint operation, also you can take part in day-to-day operation. Then you bring your asset, it will generate your own revenue, and then you incur expenses for your own liabilities. Good. So you're saying that for joint operation, we're looking at the type of joint arrangement. This is an arrangement whereby the parties that have joint control have rights to assets and obligation for the liabilities. Then number two, we have the joint venture. This is a joint arrangement whereby the parties that have joint control have right to net asset. And the parties are called the joint venturers. Then we have various forms of joint venture. We have what we call the project-based joint venture. What does it mean? Now, this is what I mean. Assuming we have the joint arrangement and we have a mega project which is worth 200 million. Now, in this case, we come up with an agreement on how we will manage that project. Now, that's what we call the project-based joint venture. We also have functional-based joint venture, all that. Good. So let's take a small break. Then we look at the specialized transaction. Specialized transaction. Take a 2-minute break. I'm the one taking the break. So we are jaribu kuangalia what we have done. Now we look at the specialized transaction. Don't use the notes, just listen what I'm saying here. And you need to pay a lot of attention here, because if you don't understand the specialized transaction, you won't understand anything in group. And number one, we have what you call the intergroup balances. And for the intergroup balances, this is the intergroup indebtedness, where one company owes the other. Therefore, this one affects the account receivables and account payables. Now, for consolidation purposes, where one company and another company are being combined, so how do we adjust for these intergroup balances? So for intergroup balances, are eliminated from both account receivables and account payables. What does it mean? X Limited sold goods to Y Limited on credit. X sold to Y on credit. So you see, if you sold to another company, to the income statement, I recognize a sale. You recognize a what? A purchase. What about the balance sheet? Now let's not talk about the income statement. I sold goods to you on credit. So how will you affect that one to the balance sheet? Now to me, I recognize what? Receivables. See, that's a debtors, right? Because I sold on credit. So in my books, I recognize account receivable or the debtor. Then on your side, you purchase good on credit. So if you purchase good on credit, you'll save that transaction as a what? As payables. Good. Now let's assume that X sold goods to Y worth 120 million on credit. That means, assume I'm the X, you are Y. So that means in my books, I'm showing account receivable of 120. You are showing account payable an amount of 120. And then we are in the same group. I'm the parent, you are the subsidiary. So at the end of the year, I'm required to consolidate the financial statement. So when consolidating, there is one transaction which is similar. While in my books, I'm showing an asset. In your book, we are showing a liability. So what happens during consolidation? We need to eliminate them. That means from my account receivable, I eliminate 120. Also from my account payable, I eliminate an amount of 120. So that's why I think that intergroup balances will be eliminated from both receivable and payable. And the amount to be eliminated should always be in agreement. If I'm showing 120, you're also showing 120. But there are some circumstances whereby I'll be showing 120, you will be showing 80. So how much is the difference? 40. Now, this 40 is what we call the cash in transit. That means initially it was 120, 120. You wrote me a check worth 40 million. So that means you recorded. So the balance now will be 80. But that check has not yet been presented to me. So therefore, I have not received. So that means my account balance is still 120. So in case there is any balance, that's what we call the cash in transit, because the amount should always be in harmony. Good. Then number two, you have what we call the intergroup sales and unrealized profit on closing stock. So how do you adjust for this? So here you have two transactions you need to adjust. One is the intergroup sales, also the unrealized profit. So for intergroup sales, are eliminated in full from both sales and cost of sales. We are saying that intergroup sales are eliminated in full from both sales and cost of sale. X Limited sold goods to Y worth 120 million, whether on cash, whether on credit. So how is that affected to the income statement? If X sold to Y goods worth 120, that means X recognizes a what to the income statement? A sale. What about Y? A purchase, of which we consolidate published financial statement, of which purchase is part of cost of sale. So that means in your book, you show a purchase, which is part of cost of sale. So that means in my books, I recognize a sale of 120 million, you recognize a purchase of 120. Now, during consolidation, we have the same transaction, which is which in my account, I'm showing an income. In your account, we are showing an expense. So during consolidation, we need to eliminate that transaction in full. That means in my sales, I eliminate 120. In your cost of sale, we made an amount of 120. Then remember, I sold good to you. I never transferred the good. This is a business to business transaction. I'm a company, you are a company. So that means when I was selling, I never just transferred. I'm here to make profit. So that means I sold goods to you at a profit. So now we want to determine this unrealized profit. Now for you to understand the unrealized profit, first of all, differentiate between the margin and markup. Margin is based on what? Sales. What about markup? Cost of sales good. Now, if you want to determine how much profit did I make on this transaction, depends whether you're given the margin or markup. Margin is based on sales. If you're told that X sold good to Y at a margin of 10, so just take 10 over 100 of that amount. A sold good to B at a margin of 20. You'll take 20 over 100. If A sold good to B at a margin of 30, you just take 30%, which is 30 over 100. What if now you are told that A sold good to B at a markup? A sold. So you're given the sales at a markup. You're saying that markup is based on what? So if markup is based on cost, and I know that X sold to Y. So you have to convert markup to margin. And how do we convert? If X sold good to Y at a markup of 10, you will take 10 over 110. Markup of 20, 20 over 1, 20. Markup of 30, 30 over 1, 30. And how do we account for that? Now let's take this scenario. X sold goods to Y worth 20 million at a markup of 20%. Markup of 20%. So how much was the profit? So that's what we call the unrealized profit. So what do you do? Hey, I think I've explained everything. Eh? So I want to get the profit. What will I do? 20 over 120. At least I have those who are reasoning. Eh? Then you multiply by 120 million. That means on that transaction, I made a profit of how much? 20. Now, this 20 is what you call the unrealized profit. Now, how do you account for this unrealized profit? Now, for unrealized profit, you add it to the cost of sales, then you eliminate it from the closing stock. Saying that for unrealized profit, you add it back to the cost of sales, then you eliminate it from the closing stock. You eliminate it from the closing stock. Why do you eliminate it from the closing stock? Now, this is what I mean. There is X here. X had sold goods to Y worth 120. And you see, I made a profit of how much? 20. If I made a profit of 20, how much was the cost of stock? Okay. The question is simple. If I sold goods to you at 120 million, and on that transaction I made a profit of 20, how much was the cost of goods? Is 100. So that means in my books, the closing stock or the value of the stock, the cost was 100. Then I sold it to you at 120. So how much will you recognize as the value of those stock? You recognize that? You recognize at 120 because you purchased them at 120. So you paid 120 to buy those stock. So that means in your books, the cost will be 120. But note that these goods are the same. These goods are the same. Yeah. Now, can you assist me with your pen? Also give me that one. Okay. Okay. Let me use this too. I think they look alike. Eh? Maybe pen ya mtu wa sweet, eh? The difference is only car, right? How much does what one cost? 10 bob. Okay, let's assume it's 10 bob, right? So what if I tell you that this is 10 bob, this is 15 bob? Will you understand that? Because what's the difference? Pen are the same. Are you together? So now that means here we have the same goods, but in my books, I'm showing the value is 100. In your books, you're showing an amount of how much? Because we are consolidating. Now, I ask, what's the difference between the two? Because the goods are the same. Now, that's when now you come to say, when I was selling to you the goods, I made a profit. Unaweza make profit ya ngapi? I made a profit of how much? So I come eliminate that 20 here. So that ibaki ngapi? 100. So 100, 100. That's why you're saying that for unrealized profit, you eliminate it from the closing stock. Good. Then number 3, we have what we call intergroup sale of fixed asset. So how do you adjust for intergroup sale of fixed asset? Now, in case of fixed asset, we have 2 items you need to adjust. One is the gain on disposal. I like calling it an unrealized profit because it's a profit within the group. Also, there will be an element of what we call the overcharged depreciation. Now, in case of gain on disposal, let me call it an unrealized profit. You account the way you accounted for this unrealized profit on sale of closing of stock, whereby this gain on disposal, you add it to the cost of sales, then you eliminate it from the PPE. Then there is an element of overcharged depreciation. Now, for overcharged depreciation is the opposite. You add it back to PPE, then you eliminate it from cost of sales. So now listen here, I explain what I mean. X sold an item of machinery to Y worth 500 million. So it's an item of manufacturing machine. X sold it to Y at 500 million. Now, since I'm selling to you, remember I must make a profit on that transaction. I cannot sell a machine at all, so I must make a profit. Let's assume the cost of this asset to me was an amount of 450. Then I sold it to you at 500. So that means in your book, you recognize the cost of how much? 500. Good. So that means I made a profit of how much? I made a profit of 50. Now, this 50 is what we call the gain on disposal. We call it unrealized profit. That's what you're saying, that for this gain on disposal, I recognize it as an income. So to eliminate, I show it as an expense. So you add it to the cost of sales. Then, in your books, you overstated the value by that 50. So that means you included that value as part of PPE. So you eliminate it from the PPE. Okay, this is what I mean. In your books, or in my books, the cost was 450. But in your books, I've shown an amount of how much? But it's the same asset. It's only that I transferred. So to make it equal, I just eliminate the profit I made. I'd made a profit of 50 so that you get 450. That's what I mean we eliminated from the PPE. Then being an item of machinery, that means it's a depreciable asset. Assume the company has a depreciation policy to depreciate that caliber of asset at the rate of 10% per annum. That means in my books, I was showing depreciation of how much per annum? Yes? If the group has a depreciation policy of depreciating this type of asset at 10% per annum, in my books, I'll show a depreciation of how much per annum? 45. What about in your books? In your books, the cost is 500. So therefore, you'll show an amount of? So there's a difference of how much? 5. Now, this 5 is what you call overcharged depreciation, which arose as a result of this profit. Is the same as doing 10% of this gain or disposal of 50. 10% of 50, what do you get? 5. That means you overcharge depreciation by 5. Depreciation is an expense. So if you overcharge depreciation by 5, what will happen to your expenses? It will increase, right? And for consolidation purposes, all the depreciation are included at the cost of sale. So that means if you overcharge depreciation by 5 million, that means your cost of sale was overstated by 5. So how do you adjust that? So you adjust by deducting it from the cost of depreciation. If you provide more depreciation on an asset, what will happen to the net book value of that asset? If you provide more depreciation on an asset, what will happen to the value of the asset? Yeah, the value of the asset reduces. So how do you rectify that? By adding it back. That's why you're adding it back to PP. PP. For overcharge operation, you add it to the PP, you eliminate from the cost of sales. Good. So I want to give you 2 minutes. Can you go through what we have done here? Eh? Everything is, don't write, but you can take a screenshot. You take a screenshot when going home, you go through it. Also tomorrow, go through it. Also on Monday, go through it. It will stick. If you don't understand that, you won't get anything on consolidation. So you can look at that. September 2021. Sorry, September 2015, question 1. September 2015, question 1. September 2015, question 1. September 2015, question 1. On 1st of October 2014, and in the date, P Limited acquired 60% of the equity share capital of S Limited in a share exchange of 2 shares of P Limited for 3 shares of S Limited. So that on 1st of October, Patterson or P acquired S Limited and acquired 60% of the equity share. Who is P? Parent. Who is S? Subsidiary. If we acquired 60%, there is an uncontrolling interest of how much? 40%. And then this was a special case. You see, when you acquire them, they usually paid the cash. But in this case, it was a share for share exchange. So you told that. On 1st of October 2014, P Limited acquired 60% of the equity share capital of S Limited in a share exchange of 2 shares of P Limited for 3 shares of S Limited. So first of all, let's determine the purchase consideration. Because the purchase consideration will help us to determine the goodwill. How do we get the purchase consideration? P acquired S. And we are told that in a share of 2 shares of P for 3 shares of S. For 3 shares of S. What does that mean? Remember, we are acquiring S. So for every 3 shares we acquire, we pay through the issue of 2 of our shares. Are you together? Now let's go to ordinary share capital. Let's go to the equity. We go to the equity. How many shares does S have? How many shares does S have? 8,000. Yeah, it's the same as you take 8,000, you divide by the par value, which is 1 shillings. Because I don't want the share capital, I want the number of shares. S had how many shares? 8,000 shares. But of this 8,000 shares, we only acquired 60%. 8 times 6, get 40? 48. So that means we acquired 14. And for every 3 shares we are acquiring, we pay through the issue of our 2 new shares. What about 48 shares we acquired? That means we issued how many of our shares? $96 divided by 3. You get? That 200 shares. So that means we acquired them through the issue of that 200 shares. Now we need to convert that one into monetary terms. Then you are told that the last sentence of the first paragraph. On this date, the shares of P were trading at 8. Yeah, the shares of P, which is that 2 we have issued, each was trading at 8. So if you convert it to monetary terms, how much do we pay to acquire them? 25? 600. That's the purchase consideration. Then we say that ordinary share capital, share premium. We say that ordinary share capital are recognized at par value, with the balance taken to the share premium. How many shares did we issue? To make sure how many shares? We have issued that 2 shares. The market price was 8, but you're saying that ordinary share capital are always recognized at par value. How much was the par value per share? 1 shilling. But the market price was 8. 1 to 8, there was a premium of how much? 7. Good. That 2, how much do you take to the share premium? You get 22? 400. Then you are told that the second sentence, second paragraph. Below are the financial statement of the two companies for the year ended that 1st March 2015. Can you underline the date? That 1st of March 2015. When did we acquire S? 1st of October. When is our reporting date? That 1st March. So how many months end of the year? Can you gauge your fingers? 6 months, right? Yeah, so that means we acquired S Limited 6 months to the end of the year. So if S has been a subsidiary for 6 months, that's very important when it comes to our consolidation. So you have the income statement for the year ended that 1st of March 2015. Then we have statement of financial position as at that 1st of March 2015. Additional information. The issue of shares on acquisition of S Limited has not yet been recorded by P. So that means P Limited has not recorded the issue of this share. So that means, remember, you say that for ordinary share capital, you don't consolidate. We only take for the parent. But you see the parent, who is P, issued new shares to acquire S Limited. So to the ordinary share capital, you add that 2. To the share premium, you add 22,400, since they have not yet adjusted. Number 2. As at the acquisition date, the fair value of S Limited net assets were equal to their carrying amount, except for an item of plant which had a fair value of 2 million in excess of its carrying amount. Read that statement again. Yeah, we are told that as at the acquisition date, the fair value of S were equal to their carrying amount. Yeah, that means the market value is the same as the net book value, except for an item of plant which had a fair value of 2 million in excess of book value of the carrying amount. 2 million above the carrying amount. So what does that mean? That means that 2 million is what we call a revaluation gain. That this asset had an excess value of 2 million above the net book value. So that's a revaluation gain of 2 million. Then you are told that the plant had a remaining useful life for 5 years as the date of the acquisition date. S Limited has not revalued its asset. So this asset, after acquisition, this was the fair value gain, which was 2. That means they never captured this 2. If they never captured that gain, and this asset is depreciable, therefore they ignore the depreciation on this. Now that's what we call undercharge depreciation. So how do we get depreciation? I told that this asset, the remaining economic life was how much? 5 years. So it's 2,000. You depreciate for the next 5 years. 2 over 5. Do you get 400? So it's 400 per annum. But you need to know that we acquired subsidiary 6 months to the end of the year. 6 over 12. You get an amount of 200. This was what you call undercharge depreciation. Therefore, they had not recognized a depreciation of 200. So that for consolidation purposes, all the depreciation will be taken to the cost of sales. So you add this one to the cost of sales, then you eliminate it from the PPE. Good. Number 3. Sales from S to Patterson, sales from S. Now that's what we call intergroup sales. And who sold to who? So you're told that sales from S to Patterson, subsidiary, sold to the parent. Sales from S to Patterson Limited in the post-acquisition period amounted to 8 million. Now, this is what we call intergroup sales. And you see that for intergroup sales, they are eliminated in full from both sales and cost of sales. Then you need to determine the element of unrealized profit on closing stock. So you're told that sales from S to Patterson Limited in the post-acquisition period amounted to 8 million. S Limited made a markup of 40% markup. So therefore it will be 40 over 1, 40. Then we are told that 2.8 million of this good at cost to be limited was still included in the inventory. So we want the unrealized profit on closing stock. So we still held 2.8 million. Now the question is, of this 2.8 we have not yet sold. The profit has not yet been realized. So it will leave the group. So how much is that? You get 800. And we see that for unrealized profit, you added to the cost of sales, you eliminated from the closing stock. Yeah, for unrealized profit, you added to the cost of sales, you eliminated from the closing stock. Number 4, S limited trade receivable. Trade receivable, trade payable. That's what we call intergroup balances. Intergroup balances. So you're told that S limited trade receivable include 800 due from P limited, which did not agree with the corresponding payable. Did not agree. We say that the amount should always be in agreement. What was the reason? This was due to cash paid by P, which is yet to be received by S. So I told that S trade receivable. So here you have S, we have P. So S trade receivable include 800. Now, if S is showing 800, you expect P in account payable also to show an amount of, but I told that this one did not balance, did not correspond with the, did not match with the corresponding payable. Why? This was due to cash paid by P, which has to be paid to be received by who? S. So that means P paid this amount, therefore the balance is 0. But this 800 has not been received by who? S. So now that 800 is what we call what? Yeah, cash in transit. So when eliminating, we see that account intergroup balances are eliminated from both account receivable and account payable. But in this case, payable they have already adjusted. The person who has not adjusted is the subsidiary, the selling company. Yeah? So you eliminate 800 from account receivable, then you add it to the cash in hand, because kama tumelipwa hatujapokea pesa, that means we also understated our cash because we have already been paid. It's only that the sales has not yet been reflected. So that means also our cash has been understated. So how do you adjust this? So you eliminate 800 from account receivable, you add it to the cash in transit or to cash at bank account. Good. Number 5. P Limited has a policy of accounting for any non-controlling interest at fair value. So we account for NCI at fair value. So that means when computing the goodwill method, which method will you use? Use partial full. Chukua note zenyu, the first page. Just take out your note to look at the first page. There is something I told you to write. Na nimeandika in brackets with a pen. Angalia hapo chini kwa II under IAS3 NCI. There's something I told you to write in bracket. If you use NCI, which method do you use to compute the goodwill? Yes, full goodwill method. Full goodwill method. So you told that S Limited policy has a policy of accounting for non-controlling interest at fair value. That means we use the full goodwill method to compute the goodwill. The fair value of goodwill attributable to non-controlling interest in S was 2.4. So in this case, you're already given. You are not given the fair value of NCI. You are given the fair value of goodwill. So they have already computed the goodwill of the NCI. So let's compute the goodwill. How do you get the goodwill? You take the purchase consideration. And how much was the purchase consideration? Iko hapa, ndio hii tulitafuta hapa. The purchase consideration was paid through the issue of shares, right? Which is an amount of? Yeah, 25,600. Then you compare against the net asset acquired. You raise net assets acquired. So the net asset acquired, you say that you take the equity element. Now let's go to the equity. Go to the equity. Now, for the equity, we have ordinary share capital. How much is the ordinary share capital? Tusikize hapa. Najua si ati, najua mnaona shida ni kusema ni gani eh? Sasa hamjui mnachukua gani. Now we are computing the goodwill on acquisition. Are you together? So is net asset acquired? Who did we acquire? Good. So how much is the ordinary share capital? Sasa unaona hiyo mnaona. You take for the company you are acquiring. Eh? Then there was what? We are taking the equity. There was also retained earnings, right? But see that for the retained earnings, you take pre-acquisition retained earnings. Pre-acquisition retained earnings. So how much is the retained earning? Anyway, 7,800. Pre-acquisition, that's for the parent. We are acquiring subsidiary. 13. Tuangalie hapa. Let me explain something here. When is our reporting date? 31st of? Now, if the year ended on that 1st of March, that means the financial year had started on 1st of October. 1st of April 2014. When did we acquire S? 1st of October, 6 months to the end of the year. 1st of October 2014. Now the question is, how much was the retained earnings at the acquisition date? Now that's what you call the pre-acquisition retained earnings. Now let's go back to the balance sheet. How much is the retained earnings of S? 13, but that one is at the reporting date, which is 13. So, but we don't want this. We want at the date of acquisition. So what you do, we go to the income statement. Let's go to the income statement. How much was the profit after tax for the year? For S. S during the year made a profit of how much? You look at the profit after tax. They made a profit of 6,000? Yes, S made a profit of 6,000 during the year. Now to the income statement, you see that for the year, so you assume the item accrue evenly. If during the year they made a profit of 6,000, 6 months, 6 months. So that means each 6 months they are making a profit of how much? 3. Profit of 3. Now, how much was the pre-acquisition retained earnings? How much was the pre-acquisition? Wacha kunyamaza, muongee kama watu wanasikiza Kenya nasema. How much is the pre-acquisition retained earnings? 10, as simple as that. You take 13, you eliminate the post-acquisition profit, the profit they made within this period, so that you get pre-acquisition. So the pre-acquisition retained earnings, you will take 13, you minus the post-acquisition profit of 3. So that means at the date of acquisition, the profit was how much? 10. Then there was another thing. There was pre-acquisition revaluation. Let's be here. We are told that at the date of acquisition, an item of S Limited had a fair value of 2 million in excess of the carrying amount. Now that's a revaluation gain. A revaluation affects the revaluation reserve. So there was again an amount of 2. How much is the total? That's 20,000. So these were the net asset. But you only acquired 60%. 60% of 20 you get 12,000. So how much was the goodwill? That is 13,600. Purchase consideration, you minus the net asset acquired. But this is what we call the partial goodwill. Right together? That's not full. Then you add NCI goodwill. You see, for this case, we have only taken for the parent. And you are told that. Now we go to note number 5. Note number 5. P Limited has a policy of accounting for any non-controlling interest at its fair value. The fair value of goodwill attributable to non-controlling interest in S was 24. This was the fair value of the goodwill. So how much was the full goodwill? That's 16,000. Now listen up here. In some question, it will be given the NCI fair value was this. This one, you are given the NCI goodwill, so you don't have to compute the goodwill NCI. So in case you are told that the fair value of NCI was this, you could have taken the purchase consideration, then you add NCI fair value. Then you determine the net asset, you could have deducted now the full 20 without taking the proportion. Are you together? You take the purchase consideration, you add the NCI fair value. But in this case, you are given the NCI goodwill as a separate item. Number 7, income tax is provided for the year. No, which question am I reading? Okay. Number 6, neither of the company declared dividend in the year ended that 1st of March 2015. Required consolidated statement of comprehensive income for the year ended that 1st of March 2015, and then consolidated statement of financial position. I want to give you 2 minutes. Now look at what we have done here, mostly for the intergroup sales and intergroup balances. Also for the goodwill, you try to interpret what I have done there before now we present. Two minutes are over. Yes. Sorry? Yeah. That's when you could have taken the purchase consideration, you add the NCI fair value, then you deduct the net asset, 20,000 in full. Are you together? But you see that in this case, we are not given the NCI fair value. You are given NCI goodwill. So if you're given the NCI goodwill, you just need to compute the parent goodwill. Then you combine to get the full goodwill. Good. So now let's start with the part A of the question. Now, part A, we are to prepare the consolidated statement of comprehensive income. Now, who is the parent company? It's P, right? Now, here, since we are combining the two companies, now it will not be P Limited. Now it's P Group. So it's P Group consolidated income statement for the year ended 31st of March 2015. So now let's start with it. Let's go to the income statement. We consolidate. We have revenue. Then you raise the cost of sales. And that's how you get the gross profit. Now for the revenue, you take for P, which is 170,000. Then you add for the subsidiary, 84. But remember, you acquired subsidiary 6 months to the end of the year. So of the 84, you take 6/12. Cost of sales will be 126. Then you add 64, but only for 6 months, 6/12. Then you add, there was depreciation, the undercharge depreciation, so that you added to the cost of sales an amount of 200. Also, you add, we see that for unrealized profit, you added to the cost of sales you made from the closing stock. So you add 800, then you minus. See that intergroup sales are eliminated in full from both sales and cost of sales in full. S sold to P worth 8 million. 8 million. Now give me that 170 plus 42. You minus 8. 170 minus plus 42, you minus 8. What do you get? You get 204. 126 plus that 2. Then you minus 7. What do you get? Sorry? 151. Good. So give me the gross profit. That's 53, right?
Yeah.
Then we have expenses. We have distribution costs. Then we have administrative expenses. Then we have finance costs. We get the profit before tax. Then we raise the tax. We get the profit after tax. Now, distribution expenses, I take 4,000 plus 2,000. You get 6,000. For admin, you take 12,000. You add that 200. You get 15,200. Now tell me what I'll do about the finance cost. Finance cost you take? Hey, tuangalie hapa. You must be understanding what I'm doing. Si ati amuelewi. What is finance cost? You take 600, you add? You add 400. In short, what I'm doing for subsidiary, it's for 6 months. Half. See, that's maonyesha working. Why should you write 6/12 and you know it's a half? So instead of 800, you show half, which is 400. Now, this one was 4,000. Now, instead of taking 4/6/12, so unajua ni half. Good. Kwa hivyo inakuja ngapi? 1,000. Give me the profit before tax. 53 minus 22, 200. That 800. Then we deduct tax. For tax, income tax expense, you take 94. You add 14 and you get 10,800. And the profit will be 20,000. Good. That's how you get the profit after tax. Then you show attributable to. 1, the NCI and to the parent company. You see what we have done, eh? For the subsidiary, for the 6 months, we have done what we call the full consolidation. There is no way you have considered only 60%. We have taken what we call the full consolidation. So that means you have the full profit. But you see, you're only controlling 60. What about the other 40%? You take it back to the non-controlling interest. And how do we get that? So non-controlling interest, you take 40% of the subsidiary profit after tax. How much was the profit after tax of the subsidiary? So 6,000, eh? But of the 6,000, you only consolidate for 6 months. So you'll take 6,000 times 6/12. So that means after acquisition, they made a profit of 3. Are we together? Of that 3, we adjust. How do we adjust? Tuangalia hapa sasa. After we acquired them, they revalued an item of plant by 2,000. Hawaku record. Na kulikuwa na depreciation ya 200. They never recorded. Depreciation is an expense. So expense will do what? Profit will reduce. So you minus the depreciation they never deducted. Then there was intergroup sale. As the subsidiary sold goods to parent. And they made a profit of how much? They made a profit of? Now that 800 has been included in that profit. So you eliminate that unrealized profit. So it will be 3,000, you minus depreciation, you minus unrealized profit, you get 2,000. That's what you call the adjusted profit. Of the 2,000, you give the NCI 40%. Is it 800? Yeah. 800. So that means of the 20,000, we attribute to the NCI 800. Now the balance you give it to the parent company, which is 19,200. You just take the 20, you minus the one attributing to the NCI, the balance is what you attribute to the parent. Get an amount of 20. Number B, P group. Consolidated statement of financial position. As at 31st of March, 2015. Yeah, there is a difference between for the year and as at. Now, for the year is what happened during the year. So you have taken 6 months. But the balance sheet is as at the reporting date. Now, as at the reporting date, S is a full subsidiary. So therefore, you consolidate in full. So to the balance sheet, you don't apportion. Sawa sawa. Hawezi chukua nyumba 6/12 kama ni aje. Yes. So, but for the income, you can still, the revenue, this is what they generated for this period. Now, to the balance sheet, you don't apportion for the assets or the liability. So you take it in full. So we have assets. For the assets, we have non-current assets. Non-current asset, we have PPE. You take for the parent, which is 6,900. Then you add for the subsidiary, 18,900. Don't apportion. Are we together? Then you add 2,000. You minus 200. What is 2,000? Yeah, revaluation. An item of PP of this was revalued upward by 2. And then later we charge depreciation of how much? 200. So how much will be the net PP? $81,600. Then there was investment property. Investment property, you take 126, and then you add 4. Z1. Sorry. Here nimechukua cost of sales. So we have 2,300. Then you add 60. And that one you get 26,600, right? Yes. Then there was goodwill on acquisition. How much was the goodwill? Then we go to the current assets. Now for the current assets, we have inventory. So inventory, you take 12,080. Then you add 5,000. So you get 17,080. Then you minus, we say that for unrealized profit, you add it to the cost of sales, you eliminate from the closing stock. So you eliminate an amount of 800. So 17,080 minus 800, you get 16. Is that 280? Then there is receivables. Now for receivables, it's 11,920. Then you consider for the subsidiary an amount of 49. Then you eliminate. There was intergroup balances. For intergroup balances, you say that you eliminate from both account receivable and account payable. You eliminate an amount of 8. 11,920, you add 41. What do you get? Sorry? 16,020. Then we have bank. Bank, you take 8 plus 3.3 and you get 11,300. Then you also add cash in transit. An amount of 800. Good. Now give me the total assets. 12,100. It can't be. You're getting an amount of 168, 600. Now we go to equity and liability. To the equity and liability, we have ordinary share capital. Also, there is share premium. Also, there is retained earnings. And then you also factor in the non-controlling interest, NCI. There is something I mentioned about the ordinary share capital and the share premium. For ordinary share capital and share premium, what did I say? You only recognize for the? You only recognize for the parent, correct? So how much is the ordinary share capital of the parent? Is that 20? Yes. You take 20, then you add, you don't add for the subsidiary. Now, on acquisition of S, the parent through the issue of share. So to the ordinary share capital at par value, an amount of that 2, then the balance taken to the share premium. Remember, the market price was 8. The par value was 1, so the premium was 7. So to the share premium, we have 22,400. This one will be 23,200. Non-current liabilities. So what do we have to the non-current liabilities? We have 10% loan note. You take 6 plus 8, no adjustment. You get an amount of 14. Then there is current liabilities. For the current liabilities, we have trade payables. And there is accruals. Now, trade payable, you add 12,300. Then you add 70,50. Then we minus what? You minus? You don't minus anything. See that for the intergroup balances, you'll make from account receivable and account pay. But in this case, nimeandika 0 hapa. We say I was to show 8, you show 8. But to that, this amount did not balance with the corresponding. Why? This was due to cash paid by P, which was yet to be received by who? So that means P paid 800 and recorded. So that means the account payable has already been adjusted. Yeah, 12. That one you get 19,350, right? Then we have accruals. Accruals, we have 4,100. Then you add 23,50. That is 64,50. Good. So now I'm remaining with retained earning and NCI. Now let me show how to get that. So how do we get the retained earnings? Now for retained earnings, you take the parent retained earnings. So how much is the parent retained earnings? So 70, 800. Then you add investee share of profit after tax. Not after tax, but investee share of post-acquisition retained earnings. You add investee share of post-acquisition retained earnings. So the parent invested in S. So we have S Limited. And we invested 60%. So we are taking our share, the investee share of post-acquisition retained earnings. Now, we acquired S 6 months to the end of the year. They made a profit of how much? Was that 3,000? So in short, you take the profit after tax for the year, which was 6,000. But of 6,000, 6 over, we want the post acquisition after acquisition. You get an amount of 3. Then we adjust. That 3,000, they had not yet deducted depreciation. You see, yes, divided an item by 2,000. So they never deducted the depreciation of 200. Depreciation is an expense, so therefore it reduces the profit. We also adjust by the subsidiary had sold to the parent good, and they made a profit of how much? 8. So that 800 has already been included in that 3,000. So you eliminate. So it's 3,000 minus 1,000, you get 2,000. 60% of 2,000, you get 1,200. And that one you get 70. 72. Hiyo hamjashika. Si unaona hamjashika? Haya, tutafute paka NCI. Non-controlling interest. So how do you get the non-controlling interest? Now, to get the non-controlling interest, you determine the net asset of the subsidiary. Then the parent took 60, then CI will take 40. So we'll take 40% of the net asset. And the net asset is ordinary share capital. Now, how much is the ordinary share capital of the subsidiary? Is that 8? Also, there was what? Retained earnings, an amount of? It's an amount of 13. We are looking at the net asset of the subsidiary at the end. So the retained earnings is an amount of? But this 13 was before making an adjustment. During the year, they depreciated an item which had been revalued. So that means they had not yet adjusted. Retained earnings factors in the profit for the year. So you minus the 200, which was the depreciation. Also the parent, I mean the subsidiary, had sold to the parent, had made a profit of how much? 800. That's what we call an intergroup profit. You eliminate. So that means the adjusted retained earnings should be 12,000. Then at the date of acquisition, there was revaluation. Revaluation of 2. And don't ask why we never considered revaluation. Now, revaluation was pre-acquisition. They never revalued after acquisition. Are we together? If they revalued after acquisition, that's when you could have shown as a revaluation reserve. But this revaluation was at the date of acquisition. That's what we call pre-acquisition. Does not affect the parent. So at the date of acquisition, the net asset of this, of subsidiary, there was a fair value of 2 which was not captured, which could have increased the revaluation by 2. So that means how much the net asset? That's 22, right? So at the reporting date, that means the net asset of the subsidiary is 22. Then you give back non-controlling interest, which is 40%. 22 times 44, is it 800? Then you add NCI goodwill. Our NCI had its own goodwill. How much was NCI goodwill? NCI goodwill was an amount of 24. So how much the net asset? 8, 9, 10. Is it 11,200? Look at 11,200. Yes. So the non-controlling interest is 11,200. Sorry? Sorry, the retained earnings is? Oh, I've interchanged, eh? Now NCI, oh, it should be 72,000, eh? Yeah, not 7,200, good. So add the total assets and liability, equity and liability. Once 160? 160. Is it hard? I know it's not hard. The only thing that have confused you is on computation of retained earnings and hiyo ndio umekuwa silent, eh? Now whenever you are silent, najuanga hamuelewi kitu. Okay. So now let me give you advice on consolidation. Consolidation, I told you that this question does not miss in each and every exam. And according to analysis, The student who got retained earnings, NCI, and goodwill correctly, it's 0.01%. 0.01%. Now, on computation of this goodwill, it requires straightforward. Retained earning in this question was straightforward. Na bado kama is straightforward, hamjaelewa. Also, NCI in this case was straightforward. Na bado hamjaelewa. What if now you get the real question now? So my advice, as an accountant, you do what I have shown you. Are you together? But as a student, those are the things to ignore. Retained earnings, because no matter how you spend your time trying to prove a point, your answer will be wrong. Also, NCI still will be. For you to get, in short, for you to get the two correct, everything must be very correct, and not just everything, including how I was arguing here. Because if P is the one who sold to S, the argument will change everything here. Yeah? Are you getting that? Yes. So that means for the remaining classes, okay, I'll show you how to get the goodwill and everything. But if I give you an assignment, don't do it to balance, because high chances it won't balance. So, yes, so I'm the only one who is supposed to balance this question in craft. So we can call it a day. Actually, everything you have them in your notes.